It is Sunday morning, January 25th, 2026. The markets are closed. Most of the world is resting. But if you think the price of silver is still sitting comfortably at $103, you are already the victim of a gap up. While you slept through your Saturday night, while you enjoyed your Sunday brunch, the global financial system quietly entered crisis mode. And most retail investors won't realize what happened until it's already too late. Gray market trading, the overnight whisper network where institutional money moves before the official open, just hit $108 per ounce. That's a 5% gap from Friday's New York close. And if you think that's shocking, technical analysts are now pointing to $115 as the next resistance level if momentum holds through Monday's Asian session. This is your final briefing before Black Monday begins. If you want to stay ahead of the herd while the mainstream media sleeps, make sure you're subscribed to this channel right now. We are the only ones covering this timeline. But here's what should terrify you. While you were relaxing this weekend, the U.S. physical silver supply chain didn't just crack, it collapsed. The biggest bullion dealers in America have effectively turned off the buy buttons. APMEX suspended pre-sales. JM Bullion is quoting 15 business days for fulfillment. That's 3 weeks, not 3 days. SD Bullion slapped purchase limits across their entire product line. This isn't a glitch in the system. This is the system breaking in real time. In less than 12 hours, the Asian markets open. Tokyo, Singapore, Shanghai. And when they do, the price discovery mechanism that kept silver orderly for decades is about to face its most severe stress test since the Hunt brothers tried to corner the market in 1980. Let me take you inside what happened yesterday, Saturday, January 24th, while most Americans were shopping, watching football, or simply enjoying their weekend. APMEX, America's largest bullion dealer, didn't just slow down operations. They fundamentally changed how they do business. 2 weeks ago, their CEO sent a letter to customers announcing unprecedented demand that required immediate operational restructuring. Shipping delays extended from their standard 1 business day to over 4 days. That's a 400% increase in processing time. But here's the detail that matters. Out of 31 core silver products that APMEX normally keeps in constant inventory, products they've sold continuously for years, only 21 were actually in stock by mid-January. 10 products simply vanished from available inventory. These aren't exotic collectibles. These are standard 1-ounce rounds and 10-ounce bars that normally have unlimited supply because multiple mints produce them simultaneously. APMEX suspended the majority of their pre-sale listings unless they felt confident they could ship the product within 2 weeks. Read that again. The largest dealer in America is now refusing to take orders for products they don't physically have in their warehouse. That's not normal market behavior. That's survival mode. I want to pause here for a second. This is the kind of on-the-ground data that CNBC and Bloomberg won't show you until it's too late. If you value this level of research and want us to keep exposing the physical shortage, hit that like button right now. It tells the algorithm that this information matters. Done? Let's keep going. And it gets worse. They implemented a $10,000 minimum on buyback orders. Think about what that signal means. When a dealer raises their buyback threshold by an order of magnitude, they're telling you they need to conserve inventory. They're telling you they can't afford to let metal walk out the door at current prices because they don't know if they can replace it. JM Bullion followed the same pattern. Customer reports flooding Reddit throughout January describe orders placed in late December still showing label-created status with no tracking movement by January 14th. That's a 2-week processing backlog on what should be same-day fulfillment. Their official website now quotes 15-plus business days for order completion. That effectively means if you order today, you might receive your silver by mid-February. Generic 1-ounce silver rounds at JM Bullion are now flagged as limited quantity. These are products that normally have unlimited supply because multiple mints produce them. When unlimited supply products become limited quantity products, you're watching the physical market disconnect from the paper market in real time. SD Bullion issued an official notice on January 3rd announcing temporary purchase limits on select silver products due to unprecedented demand and supply chain disruptions. By late January, their delivery warnings escalated from 7 to 10-day delays to availability by March 31st for certain products. That's not a shipping delay. That's a forward contract on product that doesn't exist yet. Now let's talk about what happened to premiums, because this is where you see the panic in the data. In normal market conditions, 100-ounce silver bars trade at 40 cents to $2 over spot price. That's the standard dealer margin. It's been that way for years. This weekend, those same bars are trading at $4 to $8 per ounce over spot. Some dealers are quoting $8 to $9 over spot for February delivery, for metal that doesn't ship for 3 weeks. That represents a 400 to 800% increase in dealer margins. When dealer premiums explode by 400%, you're not looking at normal supply and demand adjustments. You're looking at a run on the bank. Quick question for you, and I want you to be honest in the comments. Have you tried buying physical silver in the last 48 hours? Did you face these delays? Let me know below. I want to see how widespread this is. And it's not just the American dealers. The Royal Canadian Mint and TD Bank in Canada showed out of stock on nearly every silver bar product by early January. This is a coordinated continent-wide inventory crisis. Here's what the dealers won't tell you, but their actions reveal. They increased customer service headcount by 25%. They suspended sales of numismatic collectible silver to evaluate pricing, which is dealer speak for, we have no idea what this metal is actually worth right now. They've turned off pre-sales, implemented purchase limits, extended shipping times to 2 months, and raised buyback minimums to conserve inventory. When the 3 largest bullion dealers in America all take the same defensive actions during the same weekend, it's not a coincidence. It's coordination born from panic. The verdict is clear. Major dealers did halt sales through pre-sale suspensions, and they did slap shipping delay warnings across their websites throughout January. But more importantly, weekend premiums confirm acute physical tightness heading into Monday's open. You can't buy silver at spot price anymore. Not in any meaningful quantity, not for immediate delivery. The premium you pay now is the market's way of telling you the official spot price is a lie. Now let's turn to Chile, because what happened on Saturday in the Antofagasta region is the supply shock that Friday's closing price didn't account for. But Monday's opening price will. The Escondida mine, the single largest copper deposit on planet Earth, producing nearly 5% of global copper supply, remains under siege entering its 4th week. And on Saturday, January 24th, the situation didn't improve. It escalated. Striking workers from Finning Union No. 2 resumed their blockade of the mining route connecting BHP's Escondida and Antofagasta Minerals' Zaldivar mine to the port city of Antofagasta. Police had cleared the protest late Friday. By Saturday morning, it was back. BHP's vice president confirmed the operational impact. Our company has been affected for 4 days by a third-party conflict. The blockades on the mining route have led to intermittent vehicle traffic to and from our operations, with delays and shift changes. Let me translate that corporate language into English. Workers can't get to the mine, supplies can't reach the operation, fuel deliveries are disrupted. And when a mine can't rotate shifts and can't receive fuel, production doesn't slow down, it stops. Now, BHP hasn't confirmed a complete fuel cutoff. They're being very careful with their language. But here's what we know. The blockade affects transport of both supplies and personnel. Fuel is a supply. Fuel shipments require transport, and the transport route is blocked. You do the math. This isn't BHP's first rodeo with Escondida disruptions. The mine faced major strikes in 2006, 2011, 2015, and 2017. The 2017 strike lasted 43 days and cost BHP approximately $1 billion in lost revenue. In each of those previous disruptions, BHP declared force majeure, the legal mechanism that allows them to suspend contractual delivery obligations due to circumstances beyond their control. Typically, BHP declares force majeure within 2 to 3 days of a major strike beginning. We're now on day 4 of confirmed operational disruption from this blockade. And as of Sunday evening, BHP has not issued a force majeure declaration or client alert regarding potential delivery failures for Monday. That silence is deafening. Either BHP maintains sufficient inventory buffers to continue deliveries in the short term despite the blockade, or, and this is the scenario that should concern you, the declaration is being prepared for release during Asian trading hours Monday morning, time to minimize panic in Western markets that are still closed. Here's why this matters beyond copper. Escondida is a copper mine, but copper mining produces silver as a significant byproduct. When you disrupt 5% of global copper production, you're simultaneously disrupting a meaningful percentage of global silver byproduct flows. And in a market already experiencing structural deficits for 5 consecutive years, any supply disruption becomes a crisis multiplier. The Chilean government has not declared a state of emergency in the Antofagasta region. BHP's vice president issued an urgent call on Friday for authorities to resolve the situation so operations can continue under appropriate conditions. But that plea went unanswered over the weekend. Here's the reality that Friday's market close at $103 per ounce didn't price in. The blockade resumed Saturday. Shift changes remain blocked. Fuel supplies are disrupted. Production is compromised. And when Asian markets open in less than 12 hours, they'll be pricing in a Chile situation that is worse today than it was Friday, not better. The Friday closing price didn't account for Saturday's escalation. The Monday opening price will. Now we need to talk about the note that's been circulating through institutional money management offices all weekend. The Bank of America research report that fundamentally rewrites the rules of portfolio allocation. Published January 22nd and 23rd, Bank of America's chief investment strategist Michael Hartnett made a call that no major Wall Street bank had been willing to make publicly. Gold is going to $6,000 per ounce by spring 2026. Not by 2030, not by 2028, by spring, meaning the next 2 to 4 months. His methodology is straightforward and terrifying in its implications. He looked at the average gold price movement across the past 4 major bull markets and found that gold typically jumps approximately 300% over 43 months. If you apply that historical pattern to the current cycle, you get $6,000 per ounce by spring. Gold closed Friday at 4,180 SATers. Bank of America is calling for another 20% upside in 8 to 16 weeks. But here's the part that matters for silver. They're not just forecasting higher gold prices. They're recommending that investors fundamentally restructure their portfolios. Current central bank gold holdings average 15% of reserves, already exceeding their holdings of U.S. Treasuries in many cases. Bank of America's optimized allocation target is 30%. They're telling central banks, pension funds, sovereign wealth funds, and family offices that they should double their gold purchases to reach properly optimized reserve positioning. Think about what that means in practical terms. High net worth portfolios currently hold only half of 1% in gold, despite gold representing 4% of total global financial assets. Institutional investors are massively underweight relative to both market capitalization and Bank of America's recommended allocation. If institutions move even halfway toward Bank of America's 30% target, you're talking about trillions of dollars of capital chasing limited physical supply. And here's where silver enters the equation as the higher beta expression of gold exposure. Bank of America's framework positions silver as the amplified gold play for risk-tolerant investors. They analyzed the gold-silver ratio, currently trading around 59-1, and compared it to historical cycle lows. In 2011, that ratio hit 32-1. In 1980, it reached 14-1. If silver simply returned to the 2011 ratio of 32-1 at current gold prices, you're looking at $135 per ounce. If it matched the 1980 extreme of 14-1, you're looking at $309 per ounce. Now, Bank of America isn't forecasting $309 silver. Their base case suggests the fundamentally justified level for silver today would be closer to $60 per ounce, which means the current market price of $103 is already 70% above their fundamental fair value calculation. That premium reflects either speculative excess or, and this is the critical interpretation, a supply crisis premium that the market is pricing in ahead of actual shortages materializing. But here's why this note matters beyond the price targets. Bank of America is the first major Wall Street bank to publish a $6,000 gold forecast for 2026. And they published it the same weekend that the Chilean mine crisis escalated. The timing creates a dual catalyst for Monday panic buying. When a bulge bracket bank recommends 30% portfolio allocation to a single asset class, it signals a paradigm shift in institutional risk management. This isn't a trading call. This is a structural positioning recommendation that pension funds, endowments, and sovereign wealth managers will spend the next quarter implementing. And here's the institutional positioning data that makes Monday dangerous. Hedge funds are sitting at a 22-month low in net long silver positions as of January 13th. They hold just 15,045 contracts net long, drastically underweight relative to current price momentum. Hedge funds increased their gold net long positions to a 16-week high, while simultaneously cutting silver exposure to multi-year lows. That positioning creates what traders call a forced buyer scenario. If Bank of America's note triggers institutional fear of missing out among pension funds and family offices this week, you could see trillions in capital chasing a market where the smart money is already underweight and scrambling to establish positions. Silver's total market capitalization is estimated at $1.5 trillion compared to gold's $15 trillion market. That means a 1 to 2% institutional reallocation from gold to silver could overwhelm available physical supply. And speaking of industrial buyers, let's address the Tesla rumor that's been circulating through trading desks this weekend. On December 28th, 2025, Elon Musk sent a tweet that was unprecedented in its directness. This is not good. Silver is needed in many industrial processes. He was responding to silver's price surge and China's export restrictions that took effect January 1st. Tesla uses silver in EV battery contacts, solar panels, and power electronics. Each electric vehicle requires significantly more silver than traditional internal combustion vehicles. China's export restrictions, which reclassified silver from commodity to strategic resource, effective January 1st, cut off primary supply chains for Tesla's solar and EV production. The rumor circulating on trading desks is that a major tech company, rumored to be Tesla, is preparing an emergency off-market buy order for Monday morning to secure physical silver outside normal exchange mechanisms. Now, let me be clear. There is no confirmed reporting from Bloomberg, Reuters, or the Wall Street Journal supporting this rumor as of Sunday evening. Musk's tweet expressed concern about price levels and industrial needs, but that doesn't necessarily translate into emergency procurement strategy. Tesla's normal practice involves long-term supply contracts with miners, not spot market panic buying. But here's why the rumor persists. Industrial buyers in Shanghai have been paying $8 to $10 premiums over London and COMEX prices to lock in supply before China's export ban fully restricts outflows. If any major manufacturer breaks ranks and panic buys physical silver Monday morning, it could trigger copycat orders across the tech and automotive sectors, creating a self-fulfilling supply squeeze. Whether Tesla specifically is preparing an off-market order remains unconfirmed speculation. But industrial buyer anxiety is real, measurable, and escalating. The themes circulating in private institutional notes this weekend tell the story. Silver has been in structural deficit since 2021, with a cumulative shortfall of 820 million ounces over 5 years. The 2026 deficit is projected at 200 million ounces. China weaponized silver on January 1st by restricting exports and reclassifying it as a strategic resource. JP Morgan's first COMEX delivery report of 2026 shows them aggressively standing for maximum physical delivery against short positions. The largest U.S. bank is converting paper contracts to physical metal. And here's the London problem that nobody's talking about. LBMA-eligible silver stocks stand at 155 million ounces, while floating annual demand ranges from 900 million to 1.2 billion ounces. London cannot backstop a run on physical metal. Monday's wildcard. If even one major hedge fund announces significant silver allocation in morning financial media interviews, algorithmic momentum buying could trigger before the U.S. cash market even opens at 9:30 a.m. Eastern. So let's talk about what happens when Asia opens in less than 12 hours. Based on gray market indications, technical analysis, and positioning data, here's the forecast. Silver is expected to open between $106 and $110, with the base case scenario pointing toward $108. That represents a 5 to 7% gap from Friday's close of $103.18. If momentum holds and technical breakouts trigger algorithmic buying, the upside target is 115s, the next major resistance level where profit taking could materialize. Volume expectations for Monday's session. Elevated activity from Shanghai, Tokyo, and Singapore dealers scrambling for physical metal before the European session opens. The critical test comes at London's open, 3:00 a.m. Eastern Time. If the London physical premium widens beyond $5 per ounce versus COMEX futures, it confirms global supply dislocation is accelerating. Here are the risk catalysts to watch overnight. Between midnight and 6:00 a.m. Eastern, monitor for Chilean government announcements. A state of emergency declaration, or BHP force majeure notice, would send prices sharply higher at the Asian Open. Between 3:00 and 4:00 a.m. Eastern, London LBMA spot pricing becomes critical. Watch for backwardation deepening, which signals immediate physical scarcity intensifying. But here's what retail investors won't see until it's too late. Dealer presale suspensions mean Monday's price spike cannot be accessed at spot by retail buyers. Hey PMEX, JM Bullion, and SD Bullion have turned off presales or implemented purchase limits. Even if spot hits $110, retail will pay $115 to $120 after dealer premiums and shipping costs, locking in a 5 to 10% premium before any price appreciation. Delivery delays create hidden liquidation risk. Buyers ordering Monday may not receive physical metal until March or April 2026. If price corrects 20% in the interim, back to $85 or $90, they have locked in peak pricing and taken delivery at the worst possible moment. And here's the COMEX risk nobody's discussing. Registered silver inventory available for delivery against futures contracts stands at just 124 million ounces, only 28% of total COMEX inventory. Open interest for the March 2026 contract represents 508 million ounces of paper silver, over 4 times the registered supply. If delivery demands overwhelm registered inventory by Wednesday or Thursday this week, COMEX may be forced to implement cash settlements. That means futures longs get paid in dollars, not metal, at potentially unfavorable settlement prices determined by the exchange. So here's my forecast and warning. The gap up to $110 at the Asian Open is likely, but don't chase the spike at the Monday morning open. Let the panic wash out. The retail investor herd will panic buy into Monday's gap, providing liquidity for institutional sellers who accumulated positions at $70 to $85 in December. The smart money exits into strength. The dumb money chases it. For physical stackers, if you don't have metal in hand by Sunday night, you're too late for this immediate move. Chasing premiums Monday morning is speculation, not hedging or wealth preservation. For futures traders, the Asian gap up will likely fade into the London Open as early longs take profits. Wait for a retest of the 100 $506 level before establishing new positions. For options players, implied volatility will explode at the open. Sell premium. Consider selling out of the money calls expiring in early February, rather than buying inflated option prices. The convergence of 3 simultaneous crises, physical dealer shortages, Chilean supply disruption, and institutional allocation shifts triggered by Bank of America's research, creates the setup for extreme volatility Monday morning. But volatility cuts both ways. The gap is coming. The question is whether you're positioned ahead of it or chasing it after it's already happened. If silver opens at $110 tomorrow morning, are you buying or selling? Let me know in the comments below. And if you want to track the Asian Open with us in real time, hit that subscribe button now and turn on the notification bell. Because when the price starts moving in 6 hours, the information you need won't be coming from CNBC or Bloomberg until it's already priced in. Don't be the last to know. This is the eye of the storm. The markets are closed, the world is resting, but the financial system is breaking. Welcome to Black Monday.